Hi, my name is Weiren, Senior Portfolio Manager at iFAST. So today, I'd like to give everyone an update on the performance of our iFAST DPMS portfolios for the month of February. If you have been hoping for a good start to 2022, then you would have been very disappointed because the first 2 months of this year has turned out to be a very challenging period for global equities. After a poor start in January, market risks have continued to rise in the month of February. Inflation in the US came in above market expectations, rising to a 40-year high of 7.5%, and that has led to increasing uncertainty over how aggressively the Fed will tighten monetary policy this year to bring down inflation. In China, there was a renewed crackdown on Chinese big tech companies. Meituan was asked to lower its merchant commission fees. Ant Financial was being scrutinized once again by the Chinese government, and there were also rumors that Tencent could be facing additional crackdowns. Towards the end of the month, a war that many thought was unimaginable became a reality. Russia launched a full-scale invasion of Ukraine, causing markets to sell off sharply. So it was unsurprising that global equities actually ended the month lower by 2.2%, and that has brought its year-to-date losses to 6.7%. Fixed income markets were also mostly down in the month of February because of rising expectations for the Fed to tighten more aggressively in order to tackle inflation. All fixed income segments registered negative returns over the month, with investment-grade bond segments holding up relatively well compared to the higher risk bond segments like emerging market bonds and Asian high-yield bonds. In terms of performance, our portfolios were negatively affected by the sell-off, as you can see from our performance in the month of Feb. Our portfolios have delivered losses of between 2.2% to 4.3%, and most of them have underperformed our benchmarks, largely due to the underperformance of our developed market equity funds over the month. And this has brought our year-to-date losses in 2022 to between 4.7% and 10.7%. Since inception, our portfolios have delivered annualized returns of between 2% to 7.4%. We have made no changes to our portfolios in the month of Feb. So in terms of our inter-asset allocation, we are still overweight equities relative to fixed income. On a relative basis, the valuations of equities remain more attractive compared to bonds. In the fixed income space, there are selective opportunities, but a significant proportion of the fixed income markets is currently offering very limited value. And with rate hikes coming in 2022, fixed income assets could be vulnerable to price declines. In terms of our intra-asset allocation, for fixed income, we continue to have a short duration profile for fixed income. So within the investment grade space, we are overweight Singapore-centric short duration bonds. And within the higher credit risk segments, we are underweight both emerging market bonds and global high yield. But Asian high yield looks attractive at this point. We think the markets have already priced in a lot of negatives, and Asian high yield bonds at this point are offering some of the highest yields in the fixed income space. And the Chinese government also appears to be easing some of its policies to prevent contagion. So for these reasons, we maintain our overweight position in Asian high yield bonds. For equities, within developed markets, we are underweight US, neutral on Europe, and we are also overweight Japan. Outside of developed markets, we are also overweight Asia ex-Japan and China. And before I conclude my update today, I want to also quickly share our views on the latest escalation in tensions between Russia and Ukraine, and whether that changes our market views and how we intend to position ourselves in light of rising geopolitical tensions. At this stage, we are not calling for a risk-off stance in our portfolio allocation, so we will still maintain our overweight position in equities because the reality is that we still remain in an environment of robust earnings growth. And geopolitical crises in general are very hard to predict. They tend to be short-term in nature, and they also have the potential to rebound very quickly. as we can see from this chart, which shows a V-shaped recovery in global equity markets during the annexation of Crimea in 2014. Now, the direct economic impact is likely going to be limited and manageable, given that there is actually very little direct trade between Russia and the world outside of Europe. And even for European economies, their trade and financial links with Russia have been going down over the years after the sanctions that were being imposed on Russia in 2014. So we think the economic impact should be manageable. And we must also not forget that China is easing its policy in order to stabilize its economy. And most Asian countries are also moving towards endemic COVID-19. So opportunities still remain in the equity space. And in this kind of environment, markets are going to be very volatile. One day it's going to be up, and another day is going to be down, and the next day is going to go up again. So instead of chasing all these short-term swings in markets, I think it is more useful for us to focus more on the longer-term consequences from this conflict and position ourselves accordingly. So the more important thing for us to focus on right now is really the indirect impact of inflation through higher energy and food prices, because Russia and Ukraine are two of the world's largest grain exporters, and Russia itself is also a major energy exporter. So this crisis could further push up commodity prices and adding more uncertainty to the global inflation outlook and raising the possibility that the Fed could hike interest rates more aggressively than expected. Now, the Fed is clearly behind the curve. Inflation has been constantly above market expectations over the past few months and doesn't look like inflation is going to decelerate anytime soon, because services inflation in the US has been steadily picking up at a time when goods inflation remains high. And now you potentially have higher energy prices feeding into inflation, given the recent escalation in Russia-Ukraine tensions. So the Fed is going to have to hike rates more aggressively in order to bring inflation down. And what this means for our portfolios is that we should be positioned for a trend of rising interest rates. So instead of trimming our equity exposure at this point, what we will do for DPMS portfolios is to diversify and tilt our portfolios towards parts of the market that can outperform in an environment of higher interest rates. So one such example is value stocks, because most of our developed market equity funds are structurally overweight growth stocks. So having value exposure in our portfolios will help to diversify our portfolios. At the sectoral level, financial stocks and commodity-related stocks could also potentially do well in this current environment. And we will also continue to invest in areas of the market where valuations are still reasonable. Markets such as Japan, Asia ex-Japan, and China are all offering investors a very attractive value at this point. As for fixed income, we will continue to be overweight short duration bonds and Asian high yield. Chinese government bonds are also a good option because of the diverging monetary policies between the US and China. And the safe haven characteristics of Chinese government bonds make them a good addition to any fixed income portfolios. Now, as I speak, the human tragedy in Ukraine continues. Our thoughts are with those in Ukraine, those who are trying to escape, and their loved ones who may be watching from afar. They are living a nightmare right now, and we pray for a quick resolution to this heartbreaking situation. So with that, I conclude my update for this month. Thank you so much for your time and your continued support for iFAST.